Hello, and welcome to the Advanced Asset Management Advisors Quarterly Market Commentary Review. I'm Bob Baker, President of Advanced Asset Management Advisors, and joining me today is Phil Volker, my business partner and AAMA's Chief Investment Officer. Hey, Phil, how are you?
Good, Bob. How are you doing?
I'm very good. We're pleased to go through our commentary today for you, but before we get into the meat of it, I wanted to take a couple moments and review who AAMA is. We are an independent investment advisor, and our work is fundamentally rooted. We seek to add value by tilting portfolios toward attractive market segments through our market pricing and sector valuation investment discipline. Our highly experienced investment team, with over 30 years of average experience each, spends a lot of time and effort in evaluating the stock and bond markets. We believe we deliver a team approach which allows advisors to speak directly with me or Phil or anyone else on our team, and we provide an investment process that is easy to understand, track, and most importantly, easy to discuss with clients. Now, we've all been awakened from a deep sleep by a sound which seems as if something broke, and we probably ask ourselves, what is it? And we have said multiple times over the last couple years, the Federal Reserve would likely break something before it reached its goal of 2% inflation. Two bank failures are not the break, but they are probably indicative of the hidden impacts from widely changing monetary policy. Phil, could you walk us through this analysis?
Sure. Everybody's aware of these two bank failures. And basically, what has happened is that there were significant withdrawals from these banks, which forced them to sell securities at losses and basically made them insolvent. As sort of a industry-wide look, there is approximately $650 billion of losses on securities that are held to maturity in the banking system. And when a bank designates securities as held to maturity, they don't have to mark those to market. They can carry them at their amortized cost. The problem is when they're forced to sell those that they have to realize losses. So, as background, we live in a world of fractional reserve banking, where, in a very simplified example, banks hold 10% of their assets in reserve for those people that need to withdraw funds. They invest the other 90% in a portfolio of securities. So, as long as there are not major withdrawals, there's no problem. And there's no losses on the securities, there's also no problem. But if those securities have unrealized losses in them and the market value declines by 11%, that's enough for to wipe out the 10% reserves held in the banking system or in the bank. So, with rising interest rates over the last year, many bank portfolios are underwater, not to the degree that Signature or Silicon Valley are or were, but there are some lurking unrealized losses in the system. So generally it's understood that there's 650 billion in ignored losses on these balance sheets. And in order to soothe the market somewhat, the Federal Reserve put together a program that allows banks to take these securities that they have intended to hold to maturity, pledge them as collateral for a cash loan, and use the face value. So even though the bond may only be worth 85 cents on the dollar, the Fed will loan them 100 cents and pretend along with the bank that it's worth 100 cents on the dollar. So it's a process that sort of helps the banks continue to hide those unrealized losses.
This is kind of like the savings and loan crisis in the mid 80s, correct?
It is, and it's sort of interesting because the savings loan crisis started slow. There were, I don't know, 100 savings and loans that were resolved by the Savings and Loan Insurance Fund, and then that took several years, 3, 4, 5 years, and then it got so bad that the government created the Resolution Trust Corporation and basically said, "There's so much more work to do. We're just going to do it in one fell swoop." And within a couple years, they had all the rest of them wound up. But the cause, you're right, the cause is the same thing. It's they were taking short-term deposits and lending them out into long-term mortgages, and interest rates went up, and there were unrealized losses in those mortgages. And there was also a cap on what they could pay. As I recall, they could only pay 5% interest. Well, money market funds got over 10, 15%. So suddenly they were forced to meet depositor demands for their money, and they were quickly discovered to be insolvent. So it would be very similar, but in the early stages, and there is no interest rate cap, of course, on what banks can pay today.
Do you think the banking industry or sector is in better shape today?
Well, compared to the savings and loan as a group, absolutely, and compared to the banking sector back in '07, yes, it is. It's in better shape. The banks do not have nearly the off-balance sheet issues, and the involvement with the mortgage market is much lower today. The problem is that banks are going to have to pay higher interest on deposits to keep the money on deposit, because when individuals, corporations, anybody that's holding short term deposits, when they can make significantly more money in a government backed money market fund, or I should say, a money market fund invested in government securities, they're going to move the money to the money fund. So the banks are going to have to pay higher rates. It will hurt their profitability. There's going to be more bank failures, most likely, but not a widespread crisis because banks generally are pretty well capitalized.
Yeah. 4% in the money fund sounds a lot better than a half a percent at the bank, which, as you mentioned, is the root cause of a lot of outflows here recently. Now, there's some hidden elephants that are out there too that really aren't reported on bank balance sheets.
That's correct. I mean, the derivatives market, and some people may say, well, it's worse than it was in '07. It is larger. And of course, there's a lot of netting of risks that go with that, where a large institution that has $20 trillion of derivative contracts that they're party to can sort of net a lot of those against each other. But the point is that there's 143 trillion of derivative contracts that US banks are party to. And this is not a secret. It's reported by the OCC every quarter, complete report who the banks are, how much is under for interest rate swaps or credit swaps or equity swaps, precious metals. It's all very detailed 30-page report. The concerning part is only half of these contracts are what we call centrally cleared through a clearinghouse. And it's just like the commodities exchanges where there's a commodity exchange that stands between all parties. That exchange basically guarantees those contracts. Same kind of thing with the derivative clearinghouse. All parties that clear through there, in essence, are assured performance on their contracts through the other party. But 50% of those contracts are not centrally cleared. Dodd-Frank was supposed to have required that, but there's some loopholes apparently. So anyway, there's $70 trillion of derivative contracts that are, in essence, private contracts.
Interesting. We've had a decent recovery here in the first quarter within the stock market and the bond market. Give us a feel for things, how things look overall.
Well, yeah, the first quarter headline numbers looked pretty good. You know, the S&P was up what 7% or something. And the statisticians will tell us all that when there's a better than 5% gain in the first quarter after a down year, then that always means leads to a positive year. So, you can always find statistics that are encouraging. We're not discouraged by those kind of things, but you have to focus on what's going on in the market today and not rely upon some historical facts or statistics. So, yeah, the market rebound in the first quarter was basically a rebound of those things that got hurt the most. So, for example, long term treasury bonds were down 31% in the last year and rallied by 6.6% in the first quarter. The media will report that great gain. But if you look at the last 15 months, the long term treasury bonds are still down 26.6%.
So a lot of the banks, or many of the banks, have purchased longer term treasury bonds between 5 and 20, maybe 30 years. And so those same banks have experienced this minus 26 or something between minus 15 and minus 26 in their portfolios.
Yeah, absolutely. And, a lot of them bought long term mortgages as well. Um, so, just like every other investor that was reaching for yield, they took more duration risk. Some of them took more credit risk than they should have. Some of them probably took a combination of credit and duration risk. So, um, with 12 months of rising interest rates, it's come back to haunt the investors, and that includes the banks. In addition to the weakness then the rebound in the bond market in the first quarter, we obviously had a rebound in the stock market as well, and but it was very uneven. And one of the worst performing sectors last year, consumer discretionary, that was down 37%, was one of the best performers this quarter in the rebound at up 16. So, the media will highlight that 16% um, rally in this sector, but will not remind everybody that it's still down 27% over the last 15 months. So, and just the opposite, utilities were actually up last year, down a slight bit for the first quarter. So, still, only down 1.7 for the 15-month period, a period or a return that a lot of people would certainly love to have had.
Absolutely. And of course, the whole world is on recession watch right now. And there's a number of ingredients that potentially are leaning towards that. But you want to walk us through some of those ideas?
Yeah, there's a lot of different indicators of potential recession, and 80 some odd percent of those are based upon some portion of the yield curve. The most reliable predictor is the 210 yield curve, and it has been inverted now for 8 to 9 months since last summer. So we're right at the time point where it would say we're going to have a recession starting today. But we would point out the fact that interest rates in general are lower today in this inversion than they were back in the late 70s and early 80s. So, the impact of this negative yield curve or inverted yield curve may not be nearly as significant as it was, you know, 50 years ago or 45 years ago. 2007, interest rates were 4.3 when we were inverted, and that was only a very short inversion. So, it's the most reliable predictor, but then again, you always have to relate it to the current environment as well. One of the other indicators that's maybe not quite as reliable is the trend of the money supply. And typically, when it's down year over year, as it is now, it will precursor a recession. But you have to also look at the fact that money supply in total is still up 11, 12% annually over the last 3 years. That's because it was up 25% going into a year ago peak. So we've never seen this kind of growth in the money supply So it's not unusual or not unlikely to expect it to pull back. And the fact that it has pulled back doesn't necessarily guarantee that we're headed for a recession.
And 10-year interest rates have risen dramatically off their lows of about a year and a half, 2 years ago.
Well, that's true, but looking back, they peaked out at 4.25 last October, and they're currently at 3.55. So the bond market is sort of voting, yeah, we'll probably have a recession, or at least a slowdown in the economy because investors are buying these bonds and bringing the yields down.
Now, how about inflation?
Well, inflation has obviously been an issue. I should point out that we don't track the year over year headline numbers. It can be somewhat an unreliable indicator of what's really going on. What we do is we take the monthly change in the price indices, annualize it, and then we'll run different moving averages. For example, this chart shows the monthly in a bar chart at the bottom and then a 6 and 24-month moving average. So the CPI core headline have both tailed off from where they were a couple years ago on the month to month basis. So the 6 month core CPI is down to 5 from 6.5. So that's good. And there's been some improvement or some definitely slowing in prices in various sectors of the goods market. The problem is when you come to the service sector, the 6 month moving average of the PCE services index has not slowed down. And this is really where the Fed focuses in their observing inflation, uh, because this is one of the stickiest inflation indices, and it's heavily impacted by the labor market. So there's some good news, bad news on the inflation front. Good news is some goods prices are coming down. Bad news is that services is not giving up yet.
Do you think the Fed's done?
Well, you can ask the media, they would have told you that they were done at least 3 times, maybe 4 over the last 12 months. I think they were starting to talk about a Fed pivot last May. So anybody can speculate as to whether they're done or not. But if we focus on what the Fed says, number one, they repeatedly say that their worst mistake would be to declare victory too soon. Our observation is that fighting inflation is usually a multi year project. And there was a big stir in the markets after the two bank failures that said, oh, means the Fed's going to be cutting rates right away. Well, the next week after the two bank failures, they actually raised rates again. So to us, it's still premature to call for a Fed pivot. Will we see a pause sometime this year in the first half of the year? Most likely. I think it's time for them to step back and say, let's sort of watch things for a while. But the Fed's not predicting a pivot, and what they're saying publicly does not suggest a pivot.
And what's really interesting is this next slide. I think that when you look at the lost purchasing power since 1900, share a few thoughts on this.
Well, actually, this chart starts at 1913, and I picked that date because that's the year the Federal Reserve was created. And when you have inflation, this line goes down. When you have deflation, it goes up. And you can see the deflationary impact of the Great Depression in the early 30s. But generally, the Federal Reserve has engineered inflation to some degree since its creation. And everybody in the media talks about, oh, the inflation rate's coming down. It's now 5 instead of 7, or it's 4 instead of 6. But that doesn't mean that people can buy more with their dollars. And it's really sad, I think, to look at the people that get hurt first by inflation, and that's the lower income segments of our population. It impacts them first and hardest. And even during the beginning stages of a contraction in credit, tightening credit standards or credit criteria also hurts the same people hardest because it starts with credit cards and automobile loans.
Correct.
So, it's a history that continues. It's sort of sad in some respects, but we have it. We have to just deal with it and recognize what it is.
Yeah. Now let's shift gears for just a second and look at the stock market and forward PE ratios and just what could develop out of where we are today. You want to share a few ideas on this?
Sure. I mean, this chart, you can see the extreme high forward PE ratio where we traded in 2020 and 2021 in the low 20s, like 21 to 22 times forward earnings. And with the advent of higher interest rates, valuations declined last year and forward PE traded as low as 15. And we've rallied back to 17, back down to 15, and during one of those episodes when the market got disappointed that the Fed wasn't going to pivot, and we're back up there at 17 again. And 17 is not a bad number. If you look just across this chart for the last 10 years, it's fine. And if you go back for 50 years, it's fine. So it's not excessive, it's not pessimistic, but what you will find is you'll find spikes in the forward PE down into the 12 area. That tends to happen when you get disappointments on earnings or economic growth, meaning recessions. And also there are spikes up to, the optimistic area of 2021. So, given the uncertainties in the economy, the actual declines in corporate earnings we are starting to see, and declining expectations for earnings, and a steadfast Fed, we think that there's still a high probability that forward PEs are going to be volatile, be it driven by inflation, interest rates, earnings, you name it. The PE is going to be more volatile as it has been over the last year. So you could easily see 3 percentage points change in the forward PE, which would imply, three doesn't sound like a big amount, but it translates to roughly a 20% plus or minus change in prices to get that 3 percentage points of PE priced into the market. So, we're not predicting any extreme moves in the market here, but we do expect that there will be some volatility in the forward PE.
Absolutely. Now, given all we've talked about today, would you review how we've positioned our equity and fixed income portfolios?
Sure, the equity portfolios have now been for a couple years or more, maybe three, focused on large cap sectors, the large cap market, tilted towards defensive sectors, not 100% in defensive sectors, but definitely representing some of the defensive sectors like consumer staples, utilities, healthcare, etc., with an emphasis on strong balance sheets and earnings. Basically, a quality large cap approach, which tends to do better in more volatile market environments. And the bond portfolios, we've been in short-term, high-quality instruments for, again, several years. Like other investors, we were forced to decide how are we going to generate yield. Well, with short-term rates at zero, money market funds at zero, or close to it, we decided to take a little bit of maturity risk, go out 2 to 3 years with treasuries, and limit our exposure to credit risk and limit the duration risk, which has done extremely well relative to longer dated portfolios over the last 15 months. It took us a while we were waiting for interest rates to rise, but it has paid off for sure.
Absolutely. Well, Phil, thanks for taking the time today and walking us through a lot of these ideas. As always, Phil and I encourage you to call us if you have any questions. You can also call Aaron Plaskow, our national sales manager. We're happy to talk about the markets, our portfolios, and just how our work might be effective in assisting you in meeting your clients' investment goals and objectives. Thank you.